hedge funds slightly lagged equity markets in September, according to Hennessy Group. Meanwhile, hedgefund.net reported a slimmer improvement in hedge fund returns for the month, although performance in the first 3 quarters of 2009 was the best in 12 years. George Lucaci is here, managing director of the Channel Capital Group. He's putting out the hedgefund.net monthly performance report first here on Bloomberg. Thanks so much for joining us, George. Let's talk first about the backdrop. Slightly lagging the S&P here, as we've seen all through 2009, but not doing as poorly as the index did last year. Hedge funds really helping to limit investors' volatility.
That's exactly right. In fact, hedge funds did what they were supposed to do. Last year, they were on an aggregate basis down 15%. The S&P 500 total return index was down almost 40%. And this year, it's keeping up very well with the S&P 500 total return index, something it's supposed to be doing. So as advertised, the hedge funds have been doing very well against a backdrop of increased call for government regulations, fewer prime brokers, and an attempt for most strategies right now to look at a much more global macro picture, because the high correlations during the financial nuclear winter that began in 2007 and seems to be ending right now as far as returns are concerned. So we're getting a thaw in that.
Why? I mean, it's great, obviously, to limit your losses, and that's what you would hope a hedge fund could do. But why aren't they beating the benchmark now?
There are many strategies that are beating the benchmark right now. So as an aggregate, they're about even with the S&P total return index. But you have strategies like the mortgage-backed securities index that not only did exceptionally well last year, but is up as a #1 index in return this year, according to HFN.
All right, let's talk about who's winning and who's losing. You take a look at September, and you see really a picture of who's winning and losing throughout the year, 2009, right? You have emerging markets doing the best here in this month.
Yeah, emerging markets have come from a very low base. You see specifically Brazil and India. And interestingly, Matt, nobody's talking about India or China or Brazil right now. I don't hear that. It tends to be a lagging indicator. That is, investors returning to a certain index only happens after a few months of good return. So in short, you know, the train really left the station in February this year, and everybody still was looking at total disasters. So there is some smart money that actually got invested in April and May, but it's starting to come back again. So we saw investor flows as far as September up about 3%. So we're now at the $2 trillion mark as far as hedge fund assets outstanding. So, you know, things are looking up a little bit, that's for sure.
You know, when I think about emerging markets, though, and I think about hedge funds, recently I think about ETFs. There's so many products out there looking to copy emerging market funds or hedge funds themselves. Does it take away, you think, from the hedge fund business?
Well, I think that there's a much more attempt at diversifying into ETFs by many investors. Other investors really believe that they're looking for much more specific strategies within emerging markets. For example, distressed debt in Argentina or trade finance flows. So there's those investors who really believe that the niche players are going to continue producing alpha.
All right. Hey, George, thanks so much for joining us. George Lucaci, managing director of the Channel Capital Group. We take